In the bustling world of business, corporations stand as towering pillars of commerce. They are the engines driving economic growth and innovation, shaping the landscape of industries and markets. These complex entities, often shrouded in legal jargon, are, at their core, simply a particular way of organizing a business. They provide a structured framework that allows for efficient management and operation, enabling businesses to scale and adapt in a competitive environment. Imagine a corporation as a separate entity, distinct from its owners, much like a separate legal person. This concept is fundamental to understanding how corporations function and why they are so prevalent in the business world. This distinction is crucial, as it forms the bedrock of many corporate advantages and disadvantages. It allows corporations to enter into contracts, own assets, and incur liabilities independently of their shareholders. One of the most significant aspects of a corporation is its legal entity status. This status provides a shield of protection for the personal assets of the shareholders, ensuring that their liability is limited to their investment in the corporation. This means that a corporation, in the eyes of the law, is a separate and distinct entity from its owners, the shareholders. It can sue and be sued, own property, and even be taxed separately from its owners. This separation has profound implications, particularly when it comes to liability. It ensures that the personal assets of shareholders are protected from the corporation's debts and obligations. Shareholders, as owners of the corporation, are generally not personally liable for the debts and obligations of the business. This limited liability is a key feature that makes the corporate structure attractive to investors and entrepreneurs alike. This concept, known as limited liability, is a cornerstone of corporate law and a major incentive for entrepreneurs to choose this business structure. It encourages investment by reducing the risk associated with business ventures. Corporations, with their unique structure and legal standing, offer a powerful and flexible framework for conducting business. They can raise capital more easily through the sale of stock, attract top talent with competitive compensation packages, and benefit from perpetual existence, meaning they can continue to operate indefinitely beyond the lifespan of their founders. Understanding the fundamentals of corporations is essential for anyone looking to navigate the complexities of the modern business world, whether as an entrepreneur, investor, or simply an informed citizen. A solid grasp of corporate structure can provide valuable insights into how businesses operate and succeed. In the following sections, we will delve deeper into the characteristics, types, advantages, and disadvantages of corporations, providing a comprehensive understanding of this important business model. We will explore how corporations are formed, governed, and regulated, and examine the various roles and responsibilities within a corporate structure. Corporations possess distinct characteristics that set them apart from other business structures like sole proprietorships or partnerships. These unique features are what make corporations a preferred choice for many entrepreneurs and investors. These characteristics contribute to their appeal and have significant implications for their operation and governance. Understanding these traits is crucial for anyone involved in the corporate world, whether they are investors, employees, or business owners. One defining characteristic, as previously mentioned, is the concept of legal entity. This means that a corporation is recognized by law as a separate entity from its owners. A corporation, being a separate legal person, can enter into contracts, own property, sue, and be sued in its own name. This legal separation provides a layer of protection for the individuals who own the corporation. This separation from its owners provides a level of protection and flexibility that is particularly attractive for businesses operating in potentially high-risk industries. It allows the corporation to take on risks without directly jeopardizing the personal assets of its shareholders. Another key characteristic is the principle of limited liability. This principle is fundamental to the corporate structure and is one of the main reasons why corporations are so popular. This principle shields shareholders from personal liability for corporate debts and obligations, limiting their risk to the amount they have invested in the company's stock. This means that if the corporation faces financial difficulties, the personal assets of the shareholders are not at risk. This protection is a major advantage for investors, as it encourages investment without the fear of personal financial ruin if the business faces difficulties. It creates a safer environment for individuals to invest their money, knowing that their liability is limited. Corporations also exhibit perpetual existence, meaning they continue to exist even if ownership changes through the sale of stock or the death of a shareholder. This characteristic ensures that the corporation can continue its operations uninterrupted. This continuity provides stability and allows corporations to plan for the long term without the disruption that can occur with other business structures. It enables corporations to undertake long-term projects and investments with confidence. Finally, corporations operate under a structured management system, typically consisting of a board of directors elected by shareholders. This board is responsible for overseeing the corporation's activities and making major decisions. This board oversees the corporation's activities and makes major decisions, ensuring a level of accountability and transparency in corporate governance. The structured management system helps in maintaining order and efficiency within the corporation, making it easier to achieve its goals and objectives. The world of corporations is not monolithic. Rather, it encompasses a diverse array of structures, each tailored to specific business needs and objectives. This diversity allows businesses to choose a structure that aligns with their goals, operational scale, and strategic vision. Understanding these different types of corporations is essential for entrepreneurs choosing the most advantageous structure for their ventures. The right choice can significantly impact a company's growth trajectory, tax obligations, and legal responsibilities. C corporations, the most prevalent type, are characterized by their potential for unlimited growth and their ability to raise capital from a broad pool of investors. This makes them particularly attractive to businesses with ambitions of scaling rapidly and accessing public markets. They are subject to double taxation, meaning the corporation's profits are taxed once at the corporate level and again at the individual level when distributed to shareholders as dividends. This can be a significant financial consideration for both the company and its investors. S corporations, on the other hand, offer a pass-through taxation structure, where profits and losses are passed through to the shareholders' personal income tax returns, avoiding the double taxation burden. This can result in substantial tax savings for smaller businesses and their owners. However, S corporations face restrictions on the number and type of shareholders, limiting their growth potential compared to C corporations. They are typically limited to 100 shareholders, all of whom must be U.S. citizens or residents, which can constrain their ability to attract diverse investment. Limited liability companies, LLCs, provide a flexible alternative, combining the limited liability protection of a corporation with the pass-through taxation of a partnership. This hybrid structure offers the best of both worlds, making it a popular choice for many entrepreneurs. LLCs are well suited for small to medium-sized businesses seeking a balance between liability protection and tax efficiency. They also offer operational flexibility, allowing owners to manage the business without the formalities required of corporations. Nonprofit corporations, as their name suggests, operate for charitable, educational, or scientific purposes rather than for profit. These organizations are driven by a mission to serve the public good rather than generating income for shareholders. They enjoy tax-exempt status, making them ideal for organizations pursuing social good. This status allows them to reinvest all their resources into their mission, rather than paying taxes on their income. Professional corporations, PCs, cater to licensed professionals such as doctors, lawyers, and accountants, offering liability protection while adhering to regulations specific to their professions. This structure helps professionals manage their practice while protecting their personal assets. Choosing the appropriate corporate structure is a critical decision, best made in consultation with legal and financial professionals who can provide tailored advice based on individual circumstances and goals. The right structure can provide a solid foundation for growth, compliance, and financial efficiency, ensuring the long-term success of the business. The decision to incorporate a business is often driven by a desire to capitalize on the numerous advantages this structure offers. From liability protection to enhanced credibility, the benefits of incorporation can be substantial, contributing to a company's growth and longevity. One of the most compelling advantages is the limited liability protection afforded to shareholders. This legal shield safeguards personal assets from business debts and lawsuits, providing peace of mind and encouraging investment. Corporations also enjoy enhanced access to capital compared to other business structures. They can raise funds by issuing stock, which can be attractive to a wider range of investors, including venture capitalists and angel investors seeking high-growth opportunities. The perpetual existence of corporations is another significant advantage. Unlike sole proprietorships or partnerships, which dissolve upon the death or withdrawal of an owner, corporations continue to operate regardless of ownership changes, ensuring stability and continuity for employees, customers, and investors. Corporations also benefit from enhanced credibility in the marketplace. The formal structure and legal standing of a corporation often convey a sense of legitimacy and trustworthiness, which can be particularly valuable when securing loans, attracting customers, or negotiating with suppliers. Furthermore, corporations can offer attractive employee benefits packages, including health insurance, retirement plans, and stock options, which can help attract and retain top talent in a competitive job market.